Hi, welcome everybody. Thank you for joining us today. We're about to launch the Bannockburn World Currency Index, and it's an innovative approach. Bannockburn deals with small and medium-sized businesses, helping them navigate the foreign exchange market. Many of them have asked me about the dollar broadly, and it's a confusion about what it really means. So about a year ago, after First Financial Bank, based in Cincinnati, acquired Bannockburn, I began doing more serious research into an alternative to the commonly used dollar index. And that's what I'd like to share with you today. In its basic form, it's very simple. It's a GDP-weighted currency index. But before I get into it and delve deeper into our innovation, I need to explain to you other people who have been very important in helping launch this. Suzanne Bishopik, who you'll hear from shortly, I met her many years ago when she was managing the UN's pension fund. Her encouragement of looking for an alternative to the dollar index and a GDP-weighted basket helped encourage me through this process. Also, we've worked closely with Bloomberg to create this index, and it is already available on Bloomberg. And there's a quant person there who helped really put it together for us, really flesh out our skeleton. And she's also on the line to answer difficult questions about the composition as we get further into the Q&A process. And her name is Navita Agwawa, and she has been, as I say, she's an employee at Bloomberg who helped create this index. I'd also like to acknowledge Michael Chia, professor at Fordham. I met Professor Chia many years ago when he was at the Monetary Authority of Singapore, similar to their central bank. He was the chief representative in the United States and also was the head of the U.S. bond division. And trying to figure out what the Monetary Authority of Singapore was doing earlier in my career, it was often challenging and battling wits with Professor Chia, who now I'm happy to call my friend. At Fordham, there were several graduate students who really battle tested and really tried to explore the quantified characteristics of our new currency basket. And lastly, I'd like to thank my colleagues, Megan Flynn, who helped make this possible, as well as Dimitri, who's given me a lot of assistance in launching this. So let's get into the dollar index and our new world currency index. And here's what it looks like. On the left-hand side, you can see the Bannockburn World Currency Index. It's GDP-weighted, top 12 economic areas, currency zones. So that means that the eurozone is one. We look at 12 of these, and you can see how the dollar index on the other side. The dollar index, as you know, is heavily weighted towards Europe. Two of our four major trading partners, that when I say ours, I mean the U.S., two of the U.S. four trading partners, Mexico and China, are not even in the index. So as you could appreciate, the GDP-weighted index, and we decided to go with the nominal GDP because the alternative was using a purchasing power parity measure. And I think that was a misuse of purchasing power parity. The example I like giving is about an ant who can lift 10 to 50 times their weight. Us puny humans are lucky to lift 1 times our weight. And yet nobody would think an ant is really stronger than a person, even though at purchasing power parity it would be. So we decided to use the nominal GDP measures, and by this you can see that the dollar, the U.S. share, is 30%. And that's another important point to make here, is that in other indexes, whether the dollar index that we're familiar with or trade-weighted indexes, the dollar does not have a component. It's always a dollar against another currency pair. And what we've done, innovative approach, is using the dollar, and we just keep it at 1. As for the GDP weighting, it gets a 30% weighting. And you can see here the eurozone is second, a little bit above 20%. China, third, at a little bit more than 20%, but not quite at that eurozone level yet. And so you can see that between these three areas, that is 70% of the currency basket, of our GDP-weighted currency basket. And I'll go through these a bit later about the development and how they've moved over time. But the point there is that it's GDP-weighted. We're going to use the World Bank's calculations for GDP, which means that the basket will be adjusted every year. I wanted to show you another alternative that some people talk about, and that is the SDR. That's the IMF special drawing right. And you can see here how the US share in the SDR, almost 42%, while in the Bannockburn World Currency Index, it's only 30%. And then look at China. In the SDR, it's about a little bit less than 11%, which seems to underweight it in terms of GDP, while overweighting the eurozone. The Bannockburn World Currency Index has 12 countries in it, 12 areas, of which half of them are emerging markets and half of them are developed countries. And I think that's also important when we try to conceptualize the kind of world, not just today that we live in, but going forward, that the difference between emerging market countries and developed countries can be more narrow, of course, not at the extreme, but as you look at countries like South Korea, Taiwan, as you look at countries in Eastern and Central Europe, some of them are at levels, GDP per capita, that are very difficult to tell apart from, say, Spain or Italy or other peripheral countries in Europe. Emerging markets are not just an investment idea, but they are integrated in people's investments. And here's what we'll just give you a sense of how much our Bannockburn World Currency Index covers of the world. Here you can see it covers about 80% of the world's GDP, almost 80% of the world's equity market capitalization. And of course, in the $6.6 trillion a day in the foreign exchange market, it's a bit more than 85% of the world's turnover is captured by our Bannockburn World Currency Index. And just in the bond market, almost 95% of the global bonds are represented by those countries in our basket. This is what I wanted to refer to before. This shows you about how the basket changes over time to be more representative. Sort of the same way that the S&P 500 or the Dow Jones Industrials or other benchmarks change over time. The dollar index, of course, hasn't changed since the early 1970s, except for the advent of the euro. A couple of things I'd point out here on our compositions. One is you can see that whether it's this year, 2020, it does look like China will surpass the eurozone as the second most important area by GDP. The other countries to look at as far as the change taking place is a bit lower. We've got India and the UK. And I think that you'll see that India continues to also rise in the coming years, and that too will move it up in terms of weighting on our Bannockburn World Currency Index. So the takeaway, it's GDP weighted, it is adjusted, and those weights change over time, and you can really capture development of the world in that change. I wanted to show you a picture of what it looks like. This is the Bannockburn World Currency Index on a daily basis. And you can see how as the US dollar has weakened since the March lows, the Bannockburn World Currency Index has strengthened. And what that's really telling us as this moves higher is that the 70% of the currency index that is not the US dollar has been strengthening. And we also have show it to you on a monthly basis. And this drop since 2018, the Bannockburn World Currency Index has retraced almost half of it, while, say, the dollar index has retraced a lot more of that down move. And what that suggests to me is that we're going to see the Bannockburn World Currency Index continue to strengthen and go back to those 2018 highs. And I suspect that before this rally is over, before the dollar depreciation cycle is over, we'll be back up here near the 110 level on the index. Now, when I say that it's a basket of the 12 currencies, I want to suggest to you another innovation that we have, and that is we're not just looking at a basket of spot currencies. What we decided to do was look at the 1 month forwards. So that is to say that the basket is 12 currencies weighted by GDP, but rather than taking spot, we've taken the 1 month forward. And as you know, you can go from the forward rate to an implied interest rate. And this is what this chart monitors, which is also tracked separately on Bloomberg. This is essentially the cost one has to bear if one wanted to buy that basket, of the Bannockburn World Currency Index. What would be that funding cost, if you will? And you can see that the funding cost is below zero, which is to say that another way to illustrate that is that U.S. interest rates are above the other countries, or most other countries in the basket. China would be a notable exception. And here is what that yield, that implied yield, looks like on a monthly basis going back to 2005. And this is really a function of the forward rates and the interest rate differential between the U.S. and those other 11 members of the basket. And one way to think about it is really as a funding cost, how much it would cost to buy that basket. I wanted to share with you some other work that the students at Fordham did, some quantified work. And this, as you know, many instruments in the market are not normally distributed. They have fat tails, both on the downside and on the upside, which basically, it's sort of like suggesting that we get more frequent 100-year floods than once every 100. That is, the big events take place more than the standard deviation, normal distribution would suggest. And this is true about the Bannockburn World Currency Index as well. But you can see how tight it is for up to about 2 standard deviations. The bottom of the chart is just a measure of volatility of the index. You can see that, as you would expect, such a broad basket has very low volatility. And we'll get back to that. That's actually what this chart shows as measures of the Sharpe ratio. And what we want in the Sharpe ratio is really how much volatility you're taking for your return. And you want close to 1. And you've got Bannockburn's World Currency Index. You can see that it is higher than the dollar index. Speaks to its potential use, as we'll see, for hedging purposes. And here's what the other work that's sort of more promising and suggestive from the students at Fordham. And what they found was that they ran correlations between the Bannockburn World Currency Index and many different popular indexes that act as benchmarks for asset managers. And as you would expect, the best ratio, the best rating here would probably be with the MSCI World Index, which measures not just the advanced economies, but developed economies as well. This is, I think, a way increasingly international asset managers thinking about global in general. And so you've got the other interesting point is that the currencies look like they respond quicker. And so what the students did is they used a 1-day lag between the Bannockburn World Currency Index and the benchmarks, and found a better relationship with a 1-day lag than contemporaneous. And you can see how, as you would imagine, that the index is strongest for those kind of global measures. And here's just a sort of a hardcore example. EEM is the ETF for the MSCI Emerging Market Index. And what we did here is you can see how we have a certain volatility for the Emerging Market Equity Index, quite high, as you would imagine. And when you hedge it on a 3-month basis, not a very sophisticated, just sort of a relatively benign type of approach. I think many asset managers are looking at hedging on a monthly basis. We used a 3-month just to give some indication of sort of the promise that the Bannockburn World Currency Index suggests. You can see how it does lower the volatility by almost 200 basis points. And here is just a summary of our approach. Again, it's the GDP-weighted currency index of the top 12 economies. Half of them are high-income economies from the G7. The other are emerging markets. The eurozone is counted as one entity. Unlike other currency indexes, Bannockburn's includes a role for the dollar. And that basket is of 1-month forward rates, which generates a GDP-weighted benchmark of the implied rate. And it is already available on Bloomberg, BWCI Index, and BWCII for the interest rate index. And I leave this slide here for you, which gives you my contact information, as well as the way for people who are looking for more information for our media requests, as well as for understanding how we could use it, help you use it, the FX advisory questions below as well. And so with that, let me just turn it over to Suzanne Bishoprik, who, as I mentioned, managed the UN's pension money when I first met her. And now she advises central banks. Thank you, Suzanne.
In this exceptionally dynamic period in human history, static indexes will have no more vibrancy than petrified wood. As global investors, we appreciate the added feature of embedding the forward interest rate differentials. The Bannockburn World Currency Index will become a valuable benchmark to monitor global interest rates. I've been active in the commodity and foreign exchange markets for many years, having directed the exchange and interest rate hedging activities of McDonald's Corporation in their treasury. Importing high-quality beef for restaurants in Asia created currency exposures between many Asian currencies and the US and Australian dollars. Currency exposures arise from importing and exporting goods and capital from all over the world. Previous indexes, unfortunately, left out the world's #1 exporter, China. Not very useful. Later, as treasurer of the United Nations, I computerized the payroll and reconfigured the database for the inauguration of the euro. In designing the software, naturally, the United Nations incorporated a way to maintain and update the banking details, because as you all know, payment systems and communications security measures change. Unfortunately, the old US dollar index that is still followed today does not have a systematic rebalancing mechanism. In dynamic markets, adjustments are essential. I would say that the US dollar index is a fly in amber, a fossil that evolved after the 1970s breakup of the Bretton Woods system. No longer can it be said that, quote, the US dollar is our currency, but it's your problem, as US Secretary of the Treasury John Connally snapped to his G10 counterparts in late 1971. Unfortunately, this arrogance is still reflected in the USDX. Imagine you're a captain of a ship and assume you're given a navigational chart that omitted mention of 40% of the obstacles, rocks, and coral reefs that your ship might crash into. The old US dollar index is like a channel marker that will lead your investment ship right onto the rocks. Without the US dollar or RMB, it is simply a measure of 6 primarily European currencies, all from developed markets. The yen and the Canadian dollar are the only currencies there that represent the entire rest of the world. In contrast, the Bannockburn World Currency Index incorporates currencies from fast-growing emerging markets offering a more balanced and inclusive picture of the world economy. Without including China, more than a third of the projected growth in the world would be left out this year. Ignoring the fastest growing emerging markets also presents risks, including a high risk of underperformance. The inclusion of emerging markets currencies and the Bannockburn World Global Currency Index allows for a more balanced assessment of both risks and opportunities. For central banks, which are often more concerned about the risks, the Bannockburn World Currency Index will provide a better snapshot of the world economy. Whether it's to monitor volatility, interest rate risks, or currency fluctuations, this GDP-weighted, more inclusive index provides a better benchmark. If you enjoy studying ancient history or perhaps geology, an unchanging index might appeal to you. For investors and policymakers, a more up-to-date view of the world is much more important, including emerging markets, incorporating the forward rates, and adjusting the 12 currencies based on the World Bank's GDP data. It makes the Bannockburn World Currency Index a more powerful tool. We are happy to include this in our dashboard as of today, and we thank Bannockburn for bringing this very useful tool for our daily use. And thank you, Mark.
Well, thank you. Thank you, Suzanne. I think my technology has come back.
Good.
But so if I could so just pick up on what you were saying too, I wanted to stress this. I don't think I can share the slide again here, but let me just say that the index is, it's not just a spot index like the dollar index. It's a 1 month, it's really a basket of 1 month forwards. So the basket really generates an interest rate. That is, you can go from the forward to the implied interest rate. And this is part of the work that Bloomberg has done really, is backed out using their currency forward indexes. They've backed out, and we have now basically a 1 month benchmark of funding rate. So if one wanted to buy that basket, at what would it cost? And that's really the interest rate that it generates. And I think it's required some trying to invent this a better mousetrap, in the sense that what we're looking at here is that, as you mentioned, without having the dollar and RMB in the dollar index, it's missing something. And so I felt strongly that we needed to have the dollar represented in an index. And so what we used for the currency component, the currency basket itself, is we had the dollar's share of the world's GDP at 30%. And so we had the dollar fixed at 1. And on the interest rate side, how do we figure out what it costs to buy the dollar, in effect, is we're using LIBOR. Until LIBOR is no longer available, then we'll adopt the next benchmark. And that's part of the trying to keep it current, as you say, and active. And the other point I'd make before we can maybe open up to questions is that the interesting about the basket itself, in the sense that because it is dynamic, and this is going to be a year in which GDP changes dramatically. So, for example, it looks to me like China is going to surpass the EU or the eurozone this year. And so that would give, in the next year, we get the World Bank's GDP. That's why it's an objective basket. What the World Bank says China's GDP was in 2020, we'll use that as the weighting. And it does look to me like then we should expect that in the coming years, China's share will increase. And when I presented this and talked this through with Chinese officials, I know, of course, they love the idea because, in part, the Chinese currency is given a greater due, not only in the Bannockburn World Currency Index, but a greater share than, say, in global reserves or in the SDR, which is another currency basket that we looked at. And again, we don't think that's truly representative either because of the high share for Europe and basically the low share for developing countries, of course, by the nature of the SDR, and especially the low role for China. And so the other point that interesting about the dynamics is it looks like India, there's going to be a tough year for India, of course, with the pandemic. But it did look last year as if India was rising and that it would look like India is poised to surpass the UK in terms of the size of the GDP, which again then moves India into the top 5 countries. And the kind of world that we live in, I just don't know if I want to let MSCI or some fund manager decide what is an emerging market. And this seems to be such a fine line when you think that some East Asian countries have higher GDP per capita than some countries in Western Europe. And so I think that this, I think that if I just sum up the basket here for you. So GDP weighted nominal terms, it includes the US dollar, and it's really a basket of 1 month forwards that can back out at the sort of the implied interest rate, and the basket changes like we've seen, like how the S&P or the Dow can change to stay current with existing conditions. Same thing with this currency basket, that it can't change, it will change over time, and it would look to me like some of the emerging market countries are going to get a higher weighting in the coming years. So thank you very much for your time, and thank you, Suzanne, for your help. I'm sorry about the technical glitch. I'm still working how they get the picture inside the TV set, let alone how computers really work. I think the wind blows the wrong way and we lose a signal. But so we have time for some questions. And again, I thank everybody for your time and patience. Megan, you can help us with the questions?
Yes, and we do have a few. Okay, so one is, how does this relate to the heightened interest in digital currencies?
Yeah, if I could just say, man, Suzanne, maybe you have some ideas too. I think that we really misthink about these digital currencies. We think about them as currencies. I think what they really are payment systems. And just like if I want to buy something today, I can use cash, I can use a personal check, I can use a credit card, I can use PayPal or Venmo. And I think that the digital currency will give us just another payment mechanism that may be challenging, may be disruptive of the current payment systems because it could be instantaneous. And it doesn't necessarily mean that the Federal Reserve or the European Central Bank will be running it. They can oversee it like they do credit card payments. And so I think of this as the Bannockburn World Currency Index as a separate instrument, as a separate function, really, of and separate from digital currencies. This is a way to understand the shifting balance of power, I'd say, among the large economies, and a better, and that means more efficient, tool to reduce risk to portfolios.
I would add that if some country develops a more efficient and more secure digital currency, it could take away some of the dominance of the US dollar as an instrument of trade. One of the most important reasons central banks hold dollars is it's a very convenient means of payment. If somebody develops a better payment system based on blockchain technology or whatever, they may indeed capture more of that market share.
Good, thank you.
All right, another question. Any plans on creating other indices, for example, a better USD index?
Well, I kind of think that this could be. I mean, so our agreement with Bloomberg is that this is just really meant right now as a reference, as an index to monitor and perhaps even help analyze the markets, analyze the currency markets, analyze the risk, and give people ideas about different ways to hedge a global portfolio. And increasingly, it seems to me that that's what asset managers are looking for. So down the road, I mean, I'd be happy to talk to people about launching this as a fund or an ETF. But right now, I think that as we still continue to battle test it and to see its and to explore its quantitative characteristics, I think it's better off right now as a reference and an index.
Okay. Another question: Can we see on Bloomberg this year's weighting of GDPs that influence the index?
Look, that's a great question, because I had not said this, but the index is already available on Bloomberg, which, as I've said, has really helped create the index using some of the other indexes for us. And so you can find this on Bloomberg at BWCI, Bloomberg World Currency Index, and the interest rate component is BWCII. And again, both of these are indexes. Now, the components are not available on Bloomberg, though there's a modest description. To find the components, two things. One is to take a look at the blog that we have, Mark to Market, which is now part of Bannockburn and First Financials. And so there on Mark to Market, you'll see a drop-down button for the World Currency Index, and there we have many of these slides that I've tried to show you today, but also have the composition. Also, maybe Megan, if you could stick that up as a slide for us, the last slide of the presentation, which gives you contact data for myself and for Bannockburn. Happy to make the slide available, and also when we get done with this, when we conclude the webinar, Megan has recorded it, and I'll be able to send out where you can hear the replays and also see a better presentation of the charts.
Okay, we have another one. This one's kind of long. They've set the stage, so. I think a range of indices are useful. I agree with you that the dollar index is rather irrelevant. It's basically another name for the euro. I find trade-weighted indices more useful. I like the Fed's indices, which break out majors from emerging markets. You use global GDP weights. This will provide useful information and again is vastly superior to the dollar index. But this doesn't really capture global financial flows either. The dollar would have a 60% weight plus if you went that route. What specifically are you trying to capture?
Interesting. Well, I think that the reason I looked at GDP was primarily because I thought that not just in and of itself, I think that that's the danger, is that we sort of make a fetish out of GDP. It just amazes me that these economies like the U.S., a $20 trillion economy, that we think that on a quarterly basis we can get within $20 billion, 1/10 of 1%. Seems to me to be a stretch. So what I liked about GDP is that it's highly correlated to other factors. And so even though you're right that it doesn't pick up fully the financial flows, it does give a sense of the gravity, the respective gravities in the world. But there's, of course, there's room for plenty of indexes, and we just wanted to capture just like the heft, the size of these economies and the changing dynamics among them. Suzanne, what do you think, though? What do you think about like other types of indexes?
Well, I think the GDP weight is, if you're really looking at economic conditions, it's the best way to go. I like the fact that you're using World Bank data because it's fairly objective. And I believe it's possible to go to the World Bank's data website and confirm the rates at year end that are included in the Bannockburn World Currency Index. So I think it's a familiar measurement tool. Nothing is perfect, but I think it's the best we've got so far. So I applaud your selection.
Thank you.
All right. Another question: how frequently will you rebalance your GDP weightings?
Good question. That also takes. So what I've learned a lot from the passive investment, the explosion of passive investment, is that you don't want to have frequent shifts, and so that's why we thought that the annual adjustment that the annual, when the World Bank prints the 2020 GDP, we will reweight it. So it's once a year reweighting, which allows for an adjustment, but not too frequently. That would make it harder to manage and be not so revealing. Because remember, on most years, there's not such a big shift, and I think I'll be able to put that chart, make that chart available as well for you. Is the shift in the basket, and on most years, the relative weight of countries in the world, say we're looking at the top 12 countries, half emerging markets, half developed countries. There's not typically a big shift from year to year. It's just a slow, gradual. But of course, there's some countries like India or China that are growing more rapidly, and you do see them appreciating as far as the weight goes. But it is a very gradual process for the most part. So I think once a year reweighting does it justice. And also remember what happens with the GDP. The U.S. will report next week. The U.S. reports the first look at Q3 GDP. And so that'll be in late October. And then in November, it'll be revised. And then it'll be probably revised again in December. And then it'll be revised for many years. And so just taking a once a year snapshot probably gives us the happy medium here.
Okay, another question. This one's for Suzanne. Do you think a fixed income fund manager would hedge a portfolio of bonds as a basket or individual currencies?
It depends on the portfolio. It can be very complicated and expensive to have counterparties for each currency in the portfolio. Now, I managed the portfolio for the United Nations with 193 countries. Believe me, we would never have tried to hedge 50 currencies. It's just too time consuming. So a basket approach can be very efficient.
All right, one more question. Is its performance significantly different from the dollar index to encourage adoption?
That's a good question, because when the Fordham students did some of their quantitative work with it, it did seem to be superior in terms of, say, a higher Sharpe ratio, better correlated to some commodities, better correlated with some equity markets. And what the students found was it was actually better correlated with a one-day lag. So I get the idea that there's a big first mover advantage for the dollar index, and as Suzanne said, it's just part of it's part of what people have become accustomed to since it was launched. I think that over time, the gap between the dollar index and Bannockburn World Currency Index will grow because of the composition of the basket, the role of China, the role of India, the role of other emerging. So I think that right now there might not seem to be a large, that is to say, statistically significant difference on many measures, but I think that over time it'll be seen as a more reliable and more accurate picture of what we're trying to capture. Okay, well, thank you again, everybody, for your time. Thank you, Suzanne, for your comments and for picking up on my technology glitch. I'm a boomer. And thank you, everybody, for your time and patience today, and look forward to working with you in the future. Thank you.
Thank you. A wonderful new product. Another tool that we can use every day.